The opening speaker at this year's four-state crop insurance workshop in Grand Island was Alan Featherstone from Kansas State. Alan is the department head of ag economics at KSU and explained how financial lessons from the 1970s and 1980s could help producers weather potentially tougher times ahead. We started by asking Alan what led to the boom and bust cycle experienced during that period.
In terms of going back and looking at some farm records from Kansas back into the 1979, 80, 81 period, there were really two things that led to the boom-bust cycle, and in some respects, both of those hit their income statement at the same time. The first thing that occurred was essentially an increase in interest rates. That increase in interest rates basically hit the farmer's income statement by increased interest payments, increased debt that basically increased the amount of income going to the interest payment side of their income statement by 65%. The other thing that happened is we ended up with a strong dollar, and that ended up depressing prices further, and so the value of farm production dropped by 15%. Those two together ended up causing a situation that we were really quite good in the 1970s, where we had a lot of excess repayment capacity, to a situation where farmers couldn't pay their bills, and then that ultimately led to the decline in land values of, in parts of the country, 50–60%, that again just exacerbated those problems.
How similar are the characteristics or the situations today?
In terms of the situations today, on the interest side, a 65% increase. The last year, the average Kansas farmer ended up paying $19,000 in interest payments. And so if that would increase by 65%, it would go up to $31,000. Certainly that would hit their balance sheet and income statement, but not significantly. Probably what's more concerning, and we're beginning to see a little bit of this with the strong dollar, is the fact that crop prices are becoming depressed. And if you look at where prices are now, they're about the same level that we were receiving in 2007, 8, and 9.
I want to talk about one of the things you said today. It was loans perform for a while. Tell me what that means.
Yeah, essentially, if you look back at what happened in the financial crisis there, the average farm loan that ended up going bankrupt performed for about 6 years before it just was to the point where the bank said no more. And so what that means is that loans that they're making today did not default a year from now. And so they were still making pretty good decisions. It's those that ended up being made kind of leading up to the top of the land market that were most critical, and those were the ones that ended up defaulting. And so it's likely not going to be the loans that are being made today simply because bankers become more conservative. It's those that they made in the better times that didn't have as much margin as they needed to perform.
How much is a problem? How much default? What percent?
In terms of back in the 1970s, studying a lender, it ended up being 11% of the loans they made at the worst time they could be making loans ended up defaulting. Others ended up being worked out through the situation, but I think it's important to realize that most of economics works on the margin, and the land market is a very thin market. In Nebraska, you're probably looking at 2 to 3% of the land trading per year. And so if all of a sudden there was 4% of the land on the market, that would be a huge amount of land to work through the system. And then at the same time, there's some factors there that if interest rates increased, you may see more individuals shifting out of land and moving into CDs. That could also put more supply of land. And so the agricultural land market can get out of disequilibrium fairly quickly, causing some fairly substantial decreases in price.
So with those concerns in agriculture now about how much money people are going to have if they're just trying to minimize losses, is there one force going forward that pushes us from safety into danger, or vice versa?
In terms of, I think a lot of it is going to be managing cash flow, trying to look at your expenses and see if, again, you can reduce some of those costs. Again, there's a distribution around how well the sector is now. We've heard reports in Kansas where certain lenders are not going to provide operating for the 2016 year unless there's kind of some financial work and financial plan looking at in terms of how that's going to be paid off. And so there is going to be a subset of farmers, at least in Kansas, that potentially are going to have difficulties in 2016 arranging financing to put in some of their crop without making some major adjustments on their balance sheet, either through working their debt structure, maybe pushing that a little bit more on the long-term side, or some of them may actually have to look at potentially selling some assets in order to pay off some of that debt that they've accumulated.